Hello, my name is Tim Mollering. I'm the owner of TTM Ventures. We help people buy and sell small businesses. And today what I want to talk to you about is how to value a business. Very quick and easy calculation. I'm using what I'm calling the 95% rule. And I say that because most businesses, 95% of all the businesses out there are doing about $10 million and less in sales. And about what I'm going to tell you kind of covers about 95%, 95% of all the situations that would come up in business valuations. So, the first thing I look at is the tax returns, because that's what the bank's going to look at, that's what the buyer's going to look at, that's what CPA is going to look at. So we go to the tax return first. So on your tax return, you've got your sales. Then you've got your cost of goods sold, which is right underneath that on your tax return. Then you've got your operating expenses, which is basically everything else, that all the other expenses that have to do with the business. So that's rent, utilities, labor, if you haven't buried that in cost of goods sold, whatever, everything else. So sales less cost of goods sold less operating expenses equals net income. And on your tax return, that is basically the basis of what you pay your taxes on. So again, the math on that is sales less cost of goods sold less operating expenses equals net income. So then we go and we do what we call add backs. And our add backs are depreciation, amortization, which is the depreciation of an intangible asset, plus interest on debt, plus owner's compensation paid through payroll. So if the owner takes a monthly, weekly check through payroll, we add that back and we call that owner's compensation. So the math on that, again, you're starting with net income. You go back and you add depreciation, which is in your operating expenses, amortization, which is also in there, interest on debt, owner's comp, and that equals EBITDA, earnings before interest, taxes, depreciation, and amortization. Typically, this is where the bank stops. This is what they're using to determine the cash flow of the business or the ability of the business to support debt. Back to my 95% rule. 95% of all businesses, again, are doing about $10 million and less in sales. 95% of that is doing about $2 or $1 million less in sales. Those businesses typically sell for somewhere between 2 and 3 times cash flow. And I can walk you through why that is in just a minute. So now I say the bank typically stops there, but if all the business owners I've kind of worked with in the past is any indication, there's a lot of other stuff in operating expenses that have nothing to do with the business, but the owner is using that money to fund certain lifestyle decisions or whatever, and a new owner may not make those same choices. And so we try and add some of that back. Now, some of these things are legal and others are not legal. So I'll just kind of touch on some of the legal ones first, I guess. So let's say you've got a 401k plan and you're dumping a lot of money into that, and that is buried in your operating expenses somewhere, so we'll add that back. Let's say this would be an illegal one. Let's say your spouse, you've got your spouse's car running through the business and he or she has absolutely nothing to do with the business, but you're trying to find a way to avoid paying taxes. So if we can find that and we can justify adding it back, then we'll add that back. So there could be a litany of things. A lot of travel. Some people will expense a lot of their travel through the business and say it's business related. Let's say I've had this in the past where I've had a business owner who was actually very unhealthy. He had a blood disorder or something like that, and he was getting his insurance through the business. Well, his premiums were pretty high. and I actually sold that business to someone who didn't have that problem, so their premiums were going to be a lot less. So we were able to add that back as cash flow. So you start adding that back, and so all those other add backs, others, we'll just call it others. So it's the EBITDA plus all the other add backs gives us a new cash flow number, and we call that seller's discretionary earnings. So SDC for short. So same multiple though, just different cash flow. So seller's discretionary earnings times 2 to 3 times cash flow. All right. So now businesses that are cash flowing like maybe $200,000 or $300,000 or more, they will most likely start. We get to head north of the 3 times cash flow. There's not as much risk. Those types of businesses, they have to be big enough to in order to be kicking off that kind of business. Normally the business owner can't do everything there is in running that business, so they have to actually start hiring people to do some of the things that are necessary to run a business, which kind of spreads the responsibility and the risk out of that business, which gets to drive up the multiple a little bit because there's not as much risk. Some of the smaller ones that are cash flowing, you know, $90,000, $100,000, $110,000, a lot of that is derived from the business owner themselves, and there's risk associated with that, so the multiples aren't as high. Now when you're getting up into like the 20, 30, $50 million businesses, now we start falling into the 4 to 6 times cash flow range. Again, a lot less risk, relatively speaking. Buying a business is extremely risky, but everything is relative. So those businesses will sell somewhere between 4 and 6 times cash flow. So I'm going to go back to kind of my 90% rule and just take a normal business, and we'll just use $1 million. $1 million gross sales. And then here's my other assumption that I'm making in this presentation. Most small business owners make somewhere between 10 and 20% of gross sales. So if I've got $1 million business, that owner is probably making somewhere between 10 and 20% of gross sales. So let's just split the difference. So that would be 15%, so that's $150,000. So what does $150,000 represent as far as cash flow? Well, it's that math that I just went through. And what this represents, $150,000, is that's how much the buyer has to work with before they pay themselves or service the debt. All right? So let's take our business doing $1 million in sales, cash flowing $150,000. So why does it sell somewhere between 2 and 3 times cash flow? Well, let's go back to who typically buys a business of that size. Normally, it's someone who's leaving corporate America by choice or not, and they've got to find a way to support their family. Either they don't want to buy, or either they don't want to go get a job, or they can't get a job making what they used to, but they're young enough and they've got to find a way to support their family. So those are, majority of the time, those are the types of people that are buying these small businesses. So we have to solve their problem, which is they've got to buy it at a price that makes sense for them so they can support their family. So we'll take our $150,000 cash flow business, and again, if I apply my 2 to 3 times cash flow number, that means that business would sell somewhere between $300,000 and $450,000. All right. So most of our businesses are financed through the SBA. The SBA is what I call a cash flow lender. Not as concerned about assets of the business. All they care about is how are you going to pay me back, and you pay me back in cash. So let's figure that out. So the SBA, if there's no real estate involved, it's a 10-year note. It's a 10-year note, and right now it's we're in September of 2014. Rate right now is about 6%. That's a little high. What I'm saying is a little higher than what it actually is, but that's about what it is, 6%. So I did my math here. So at $300,000, and the SBA typically requires the buyer to put somewhere between 20 and 25% down and I'm going to use 20%. So at a purchase price of $300,000, that means the buyer's putting 20% down. That's $60,000. That's how much they have to write a check for to give to the bank to get the loan. So that means they're borrowing $240,000. 10-year note, 6%. The monthly payment on that is $2,664.49. Or for a yearly debt service of $31,973. So, if we're working with $150,000 less, let's call it $32,000 for debt service, that equals $118,000. So a new buyer would make about $118,000 at 2 times cash flow. Okay, so you got $150,000 to work with because that's what the business is cash flow now. Then they got to service the debt at $32,000. They net $118,000, and they wrote a check for $60,000 to get at that opportunity. That's actually a pretty good deal. Pretty good deal. And most sellers aren't willing to necessarily sell it for 2 times cash flow. So we'll go to 3 times cash flow. So at 3 times cash flow, that's $450,000. Buyers put $90,000 down. 10-year notes, they're borrowing $360,000. 10-year notes, 6%. The monthly payment on that is $3,996.74. Debt service on that is $47,960. So let's call it 48. So back to my math. 150 minus 48. That's 102. So 150,000. That's cash flow business right now. Buyers got $48,000 of debt service. They'll net 102, and they wrote a check for 90 to get at that. That's pretty good too. Most businesses will sell somewhere in 2 to 3 times 2 to 3 times cash flow, so they'll sell somewhere in that range. And I tell a lot of my buyers, what you want to make is about how much you need in cash in order to buy a business. But again, the problem we're trying to solve, or the problem the buyer's trying to solve, is they're trying to buy a business that cash flows enough so they can support their family. And that 2 to 3 times cash flow is a number that allows them to do that. Now the next, so there's other things that I did not talk about. Bigger businesses, you've got stuff like capital expenditures and whether you should add those back or not. And I can talk about that at a different time, but my objective today was to just get people in the ballpark as to how to value a business. It's not 2 to 3 times sales. It's 2 to 3 times cash flow. So if you have any questions, feel free to reach out to me. Next video, I'll talk about some of the that 5% of those issues that are not addressed in the quick profile or the quick business valuation I did right now. Thanks for listening. Call me if you have any questions.